Welcome to The Explainer. Today we're going to unravel one of the most powerful and, honestly, most important tools for figuring out if a business is truly healthy, the cash flow statement.
But let's kick things off with a puzzle. You see a company in the news, right? Sales are through the roof, profits are setting records, everything looks absolutely fantastic. And then, just a few months later, that same company is in deep financial trouble. How on earth does that happen? Well, the answer reveals a critical secret about how businesses really truly work.
All right, so to crack this mystery, you've got to get your head around one core idea. The profit a company reports is not the same thing as the cash it actually has in the bank. I know it sounds weird, but they can be two wildly different numbers.
A really great way to think about this is using the Hindi terms kitab and gala. The kitab is the accounting book. It's where every single sale gets written down, even if the customer bought on credit and hasn't paid a rupee yet. But the gala, well, that's the cash box. It only holds the actual cash that's been collected. A company can look amazing in the kitab, but have a totally empty gala.
So why does this gap even exist in the first place? Well, it's all down to a system most businesses use called accrual accounting. The rule's pretty simple. You record a sale the moment it happens, not necessarily when you get the money. And it's the same for costs. You record an expense when you get the bill, not when you actually pay it.
Let's walk through a super simple example to really see how this plays out. Imagine you sell a t-shirt on Christmas Day. With the accrual system, you book that 10,000 rupee revenue right there in December. But what if the customer pays you on January 5th? See, if you were using a simple cash system, that revenue would only show up in January's books. That timing difference? That's everything.
Okay, so the big takeaway here is that the income statement, that's what shows us the kitab profit. It's an important number, don't get me wrong, but it's not the full story. So if we want to know what's really going on in the gala, where do we look?
Well, that is where the cash flow statement comes in. Honestly, you can just think of it like the company's bank passbook. It doesn't care about fancy accounting theories, it just tracks one thing and one thing only. Where did the cash come from and where did it go? And what's so brilliant about this statement is that it splits all of a company's cash movements into three super simple buckets. First up, you've got operating activities. This is the cash that comes from the main business. Next, you have investing activities. This is cash used for big-ticket items like buying a new building or equipment. And finally, there's financing activities. This is cash from investors or banks.
Let's make this super real. Say your business is selling potatoes and onions. The money you make from those sales, that's your operating cash flow. Now, if you take some of that cash and buy a bigger shop, that's an investing activity. And if you go to the bank and get a loan to expand even more, that's a financing activity. See? Simple, right?
Okay, so all three of those are important, for sure. But for now, let's zoom in on the operating section, because this is where you find the real truth about a company's day-to-day financial health.
And this is the part that really solves our original puzzle. It acts like a bridge. It starts with that book profit we saw in the income statement and then makes a few key adjustments to show us the actual operating cash the business really generated.
The secret sauce to building this bridge is adjusting for something called non-cash expenses. Now, these are just what they sound like. They're expenses that lower a company's profit on paper, but no actual cash ever leaves the gala.
Depreciation is the absolute classic example. Just imagine a company buys a big computer system for 10 lakh. All 10 lakhs of cash goes out the door today. That's a cash outflow for investing. But here's the thing. For accounting, they don't record a 10 lakh expense today. Instead, the rules let them spread that expense out, say 2 lakhs per year for 5 years.
So here is the magic trick. In year 2, that 2 lakh depreciation expense makes the company's profit look smaller. But no cash actually left the business that year for it. So, to get from that paper profit back to real cash, we have to add that non-cash expense back in. It's a simple little tweak, but it is so powerful.
And once you understand this process, it kind of clicks why, for so many smart investors and analysts, cash isn't just important, it's everything. It's king.
You know, there's this classic question they ask in finance interviews. It goes something like this. You're stuck on a deserted island, and you can only have one financial statement to figure out if a company is a good investment. Which one do you pick?
And the answer,
almost every single time, is the cash flow statement. And why is that? Because of that old saying, profit is an opinion, cash is a fact. The cash flow statement just cuts through all the accounting estimates and illusions and shows you the cold, hard reality of how much money a business is actually making.
I mean, even the legendary investor Warren Buffett put it perfectly. He famously said that accounting is the language of business, and he argued that if you're not willing to put in the effort to learn that language, you probably shouldn't be picking stocks on your own. And understanding cash flow, that is a fundamental part of being fluent.
So what's the big takeaway from all this? It's simple, really. The next time you see a headline screaming about a company's record-breaking profits, you're now going to be the smart one in the room who asks the most important question of all. That's great, but where's the cash?